All right, folks, I'm Mike Berger. I'm the managing editor of LBM Journal, and I want to thank you for joining our webinar entitled The Importance of Understanding Valuation. And I want to apologize for my voice. I am just getting over a touch of a head cold, so my apologies if I'm a little froggy in the throat. Your business is likely your most valuable asset, and as such, it deserves a well thought out succession plan. The first step in developing one should be to invest in an independent, reliable, unbiased business valuation by a firm that understands the LBM industry. With the last 2 years of economic turbulence, having an objective value of your company provides the foundation for effective succession planning. Your business is likely your most valuable asset, and knowing the value of your business is imperative because it fuels important decision-making like tax planning, funding your post-ownership goals, and negotiating a sales price. Now, today's webinar is presented by Sam Brownell, founder and financial advisor at Stratus Wealth Advisors, who is also the sponsor of today's webinar. Sam Brownell, CVA, CFA, MBA, has been a financial professional since 2006 and formed Stratus Capital Management in July 2013, which has since grown into Stratus Wealth Advisors, to provide the goals-based financial planning and investment management to individuals, families, and independent business owners. They have all sought out Sam's advice on their short and long-term planning needs, including evaluation, tax strategy, business continuity planning, and succession planning. In 2019, Sam obtained the CVA certification from the National Association of Certified Valuators and Analysts in order to better serve the valuation and succession planning needs of his independent business owner clients. You can learn more about Stratus Wealth Advisors at stratuswealthadvisors.com. Now, a couple of details before we get started. All attendees are muted, so you can hear us, but we can't hear you. So if you're having any technical issues, click the chat button at the bottom of the screen to send us a message, and we'll work to quickly address any problems. If you have questions for Sam, click the Q&A button at the bottom of the screen anytime during the presentation, and he'll address as many of those questions as possible at the end of the presentation. And lastly, we expect this webinar to be finished in about 30 to 40 minutes. We are recording it, and we'll send a link to the recording to everyone who registered. Plus, it will be posted on lbmjournal.com. And with that, I turn the webinar over to Sam.
Great. Thanks, Mike, and thanks everybody for joining us here. We know it's a busy time of year as you're coming down to the end of the calendar year, so we really appreciate you listening in today. And as Mike said, we're going to give you some ideas today on what are the different reasons you would get a valuation and how does that play into your business and succession planning, because it is really important to get an unbiased view of what is going on from the perspective of not just the value of your business, but how it's operating and how you may be able to transition it from one generation of leadership to the next. So as Mike said, no need to spend a lot of time here. My name is Sam Brownell. I work for Stratus Wealth Advisors. We are a firm that focuses the majority of our business in the LBM space, working with independent dealers and independent business owners across the country. We do business valuations, and we work with folks about how to maximize that value, because lots of times that's what we need to do, right? As we've invested a lot in our business, how are we going to help that business get to a value that it needs to be so that we can fund our lifestyle going forward? Then we coordinate and put together succession plans for folks. And that's a lot of fun because we get to be along and help this process go from formulation stage to an actual transition. And then we also work to help coordinate personal and professional planning. And we do provide asset management services too. So kind of a full service, or we can bolt on and do any type of ancillary services within our larger service of to independent business owners. So thought we'd start here with this little comic, because this is what we want to avoid, right? The whole idea behind getting a valuation is so that we don't have to end up at a point where we are hoping, we're going to our financial advisor, our CPA, our investment banker, and saying, boy, I hope you can sell this for as much as possible because I need it. And we need to do the planning up front. And so 3 to 5 years before your ideal transfer would be a good time to just get a value of the business. You don't necessarily need to start down the succession planning road, but it always helps to know what the business is worth. And one of the things that we say a lot when we talk to folks is, if you were going to go on a hike, you would want to know where the trailhead was. Otherwise, it'd be very difficult to go on the hike. And it's the same thing with planning for your business. If you don't know what your business is worth, you're really taking a shot in the dark at whether or not you can move from where you are today to where you want to be when you ultimately transfer ownership of the business. So some statistics, and these change over the years, but there are a number of surveys out there that ask business owners things like, who do you plan to sell the business to? Do you know the value of your business? From our understanding and from reading these studies and working with business owners, we'd say that a good 90% of folks don't really know the true value. They might have an idea. Oh, I heard it's 5 times my earnings before interest, taxes, depreciation, and amortization. I've heard that it's 4 times, or I could get 6 times if I went to the right buyer. But that doesn't give you a real objective value of what the business is worth. And the objective part is really important here, because we all, and I know this as a business owner myself, we all think our business is worth more than it is. You have to be a business owner. You have to be optimistic. You have to pour your heart and soul into this. The problem is that when you're transitioning ownership of the business, it's not what you think the business is worth. It's what a hypothetical buyer would pay for your business. And that's really where we need to know the true value of the business, because if you don't, most business owners, as you can see here, 80% in the study that we looked at, are planning to fund their retirement by selling their business. And so therefore, we really need to know what this business is worth, because otherwise our biggest asset is a big question mark when it comes to our planning needs. So any valuation, and we're going to get into some details here, hopefully without going too far into math class and making everybody's eyes gloss over. But one of the things you need to know for any valuation is there have to be parameters set up. Value is an ever-changing thing, just like our revenue and our margins and our net profits. All of these things are changing. And so we need to define right up front, what are the parameters for this valuation? And so the 4 questions that any evaluator who comes in and looks at your business should ask are, what is the purpose of the valuation? And is this going to be for merger and acquisition activity? Is this going to be to gift or grant shares of the business to a child or a key employee? Is this part of planning? And all of these different things, and we'll touch on each of these, but each of these purposes is really important because it may change how the valuation is done. And then we have to talk about what's the type of value. And there are 2 primary types of value when you look at a business. There's equity value and there's enterprise value. Equity value is what you as the owner get paid. That is what you are going to take home, obviously before taxes and before you have to pay, whatever advisors there are or lending fees to a bank. But that gives you an idea of what your pre-tax gross take home is going to be. That includes things like non-operating assets, right? Cash is considered a non-operating asset from a valuation standpoint. It obviously subtracts debt. You need to pay off debt before you take your money out of the business. But that's the value that you as the owner can look at and say, that's what we can take home. The other value is enterprise value. Enterprise value is if you go through a merger and acquisition, the value that will be calculated there and the value that is calculated when you're using your EBITDA, right? Earnings before interest, taxes, depreciation, and amortization. That EBITDA multiple times your adjusted EBITDA is going to give you enterprise value. That is the value of your operations of the business. It does not include non-operating assets, but it does include debt. What is the value of the operations of the business? And so we need to know what type of value we're calculating before we go into this and how that will be used to help you as the owner. Another critical one is the date. The date of the valuation matters. And imagine if somebody was looking at your business in June of 2020 versus June of 2021. Like the last 12 months might look a little bit different, especially in an industry like this. So the date of the valuation matters. And we'll see in some specific examples, like in a buy-seller shareholder agreement, how it can be critical. But we need to set a date for the valuation. And the final is discounts. And many of you may have heard of this from a valuation perspective, but there are two typical discounts that are applied or can be applied depending on the situation. One is a discount for lack of control. If I own less than 50% of the business, my shares are going to be worth less because I don't have control over the strategic and operational decision-making that somebody who has greater than 50% has. The other one is a lack of marketability. All private businesses have the issue of there is no ready market for the shares of the business. Unlike if I have Apple in my portfolio, I go on Schwab or Fidelity or whatever my broker is and I hit sell, boom, sold. Not the case with a private business. And so a discount for lack of marketability is basically taking into account the fact that there are transaction costs. There are frictions associated with selling a private business. Right? These can include things like you have to pay folks, M&A bankers, CPAs, other advisors. There's going to be some type of success fee if you use an investment banker. There's probably some opportunity cost in there. There may be some tax cost associated. So all of these things, these frictions to selling a private business are taken into consideration in a discount for lack of marketability. And this discount will apply in some situations and not in others, because obviously there are certain situations where you will want to produce a lower valuation. And there are other situations where you want to show yourself at a higher valuation. And so that's all part of the process. And that's why we set a purpose for the valuation. So just so that we can go through this again, because it's really, really important. Equity enterprise, two types of value. Really important to understand the difference. Equity is a value to you as the business owner. That's what you're going to walk away with before paying taxes and other fees. Enterprise value is what your business is worth to a third party. What are the operations of your business worth to a third party? And these are typically not the same. Right? And you have to get through your head. It's a little bit tricky sometimes, but valuation, there's science to it, but there's also art. And two people can look at a company and come up with a different value. Well, the same person can look at the same company and come up with an equity value and enterprise value, and they are generally not the same. And as you see at the bottom, the typical formula for going from one to the other is equity value is enterprise value minus debt plus cash. That's a very simple way to think of how you would go from I have my enterprise value, I subtract the debt because it has to be paid off before the equity owner walks away, and I add back cash because cash in most situations will go with the owner of the business. So keep that in mind as we walk through these next couple slides and some examples of valuation. So these are the 5 things we're going to touch on today. And each one of these valuations we're going to go through and we're going to look at the purpose. We're going to look at the type of value. We're going to look at valuation dates. We're going to look at discounts. So you get an idea of when these are going to be useful. And then we'll give an example of each. So an initial conclusion of value. Whenever we start a succession plan, the first thing we want to know is what's the value of the business? Because that sets the stage for all the other planning work we do. What value do we want to know? Equity value, because we want to know what the owner of the business is going to walk away with. And we want to know at the end of the day, what is the owner of the business going to walk away with? What do we usually do? How do we date this valuation? Well, we take the most recent month end for which financials are available. And we want to get the most clear picture for the most recent date of what the business is worth, right? And then discounts that could apply here, well, it depends. It depends what interest might be transitioned. Are we just looking at a 10% interest? Maybe we're bringing on a family member, right? Let's do a 10% valuation here of the business. Well, that could be a lack of control right there. And typically there will be a marketability discount, because when we start our planning work, we want to show you what are typical fees that will be deducted from that equity value at the end of the day, because what we care about is net value, right? That's what you're walking away with, not gross value, but net value. And so that's why we'll typically add that lack of marketability discount in, because we want you to see, oh, okay, well, it could be a 5% success fee for selling through an investment banker. There's opportunity cost to holding money in the business versus somewhere else. So really important that we set the stage and we do it in a realistic, conservative manner. Let's talk about an example here. What type of person would need this? Who would want to get an initial conclusion of value? Well, somebody would call us up and say, here's my situation, right? In my mid-60s, I don't have any children working in the business. I'm the one who's running a lot of the primary functions of the business. I've got some interest, right? There's some internal interest here. What do we do? All right, well, we need to do an initial conclusion of value, because we need to decide what you might get from this business if you sold it internally to one of these two people. Maybe the child comes back and works in the business. Maybe an employee or a group of employees decides to buy out the business. What does that look like? All right, so this is where we look at an initial conclusion of value. Now, changing gears a little bit, if you have multiple owners, you need to have a buy, sell, or shareholder agreement. It's called different things in different places, but you need to have an agreement in place that discusses what would happen, how the business would be valued if a trigger event occurs. And these trigger events are death, disability, divorce, personal bankruptcy, termination, including retirement, right? You could be retired from the firm, or an owner could be forced to terminate from the firm. And so these are things that they happen, right? People die, people become disabled, people get divorced. What happens to the business interest? It needs to be very clearly spelled out. What's transitioning here is equity value, right? I am buying your shares, or the company is buying back shares of an owner who is deceased or who has a disability. We need equity value. When should the date be set? Well, it's the end of the month immediately preceding that trigger event, right? That removes a lot of potential for argument, because obviously, or the seller's family's mind, they want to set that valuation date at a time where it shows as much value as possible, as much profit as possible. If you're the buyer, no, I want to reset that value so that it's at a date that has the lowest possible value, so I don't have to outlay as much cash. It needs to be very clear in writing prior to a trigger event that the date will be set as of the month end preceding the trigger event. Critical. Same thing with discounts. You can include them, you cannot include them, but they need to be specified in the shareholder agreement. We've seen more issues crop up around valuation when there is a trigger event because things were not well spelled out. And what ends up happening is somebody always ends up with hurt feelings in these situations because things were not spelled out well. So really important. If you've been in business for a long time with a partner, maybe you took out life insurance policies, but that was a long time ago. The business is worth a lot more now. So buy-sell agreements can do things like spell out, how do we use those insurance proceeds? Who do we provide this information to? And then how does that go into the valuation and the transition of the business? When a trigger event happens, there's typically a lot of emotions. The more that can be written down ahead of time, the easier it makes this transition for everybody. The family of potentially a deceased owner the owner themselves, if they're going through a divorce or they've had, some type of accident where it's left them disabled, or maybe they're just retiring. We want to make sure that this transition doesn't mess with the overall operations of the business. All right, third, estate or gift tax valuation, or it could be for a grant, right? Gifting an estate within the family. Granting could be to a key employee, right? And here we're trying to establish a value for a portion of the business that will be gifted or granted to the next generation of ownership. Again, we're looking at equity value because we're still staying within the business, owner to owner. Once again, what are we looking at? We're looking at the date that we have the most recent financials, or if it happens to be a death, right? So we're doing an estate tax valuation, it would be the month end immediately preceding. So this becomes really important because then we get into discounts. And when we do a gift, estate, or grant valuation, we are going to put in discounts. We want to make sure that we are being objective, right? Because we can't just say that the business was worth a lot less than it was, but we want to take advantage of every single bit that the IRS gives us and allows us to do in these valuations. And the more we can add a couple discounts in there, we can reduce what you might have to gift against, let's say, your lifetime exemption. That can provide for additional down the road estate planning, because we have not had to transition this value of 10%, let's say, of the business at full cost. We've been able to discount it a little bit. And that may matter, and it may matter even more if the current estate tax limit, which is double what it was 4 years ago, that's going to sunset December 31st, 2025. And so that limit's going to go back from about 24 million from a married couple to about 12 million. And so these types of strategies could make a big difference. So again, what type of person would need this valuation? Well, again, up top, if we go through, we do that initial conclusion of value, we determine you don't need every single dollar from this business to fund your post-retirement lifestyle. We may say, well, geez, you can reduce taxes in this by gifting or granting an interest of the business to the next generation, right? That can be a great way to think about taxes while still not just giving the business away. So these are things to think about. And this is why the succession planning process is important, because we have to know whether or not you're going to need all that value. And if you don't, well, maybe there's an opportunity to gift or grant. The last thing I'll say about these types of valuations are all valuations are very involved and time consuming. These especially so, because not only do we have to determine a value, but we also have to write a report to defend that value that then gets filed with a tax return to the IRS. And there's no statute of limitation on these valuations. So they could come back 10 years from now and question the value of your business. And so it's really important that this is done right and that the report really defends the value that we've determined. All right, transition scenario valuations. First step, we find an initial conclusion of value. Then we do a post-ownership cash flow analysis. Now we're ready to decide, all right, what happens? What are the transition options? What are best given the owner's goals? What are best given the tax parameters? What are best given the cash flow needs? And then let's put together what this looks like. This could either be equity or enterprise value, right? Depending on whether it's going to be an internal or an external sale. And that's going to matter because those are two different values, right? At the end of the day, the owner is going to walk away with equity value. But if we're looking externally, if we have somebody coming into us and saying, okay, Mr. and Mrs. Business Owner, we'd like to pay you $5.5 million for your business. Is that a good price? Well, we don't know. We have to go and we have to calculate that enterprise value. So another reason that it may be useful to go through and look at enterprise value and equity value in a transition scenario valuation or valuations. Right. And so some different options here, but what we're really trying to do underneath the hood is we're trying to give the owner data, actionable data, and say, based on our analysis, here's what we think the valuation would be if you sold to a family, if you sold to your workers through an ESOP or a cooperative, right? Or if you sold to a third party. And how would that play out in the rest of your succession plan? And how would that play out in terms of what you're going to get at the end of the day and ultimately what taxes you're going to have to pay on it? Final one we're going to talk about is the sellers or M&A, merger and acquisition valuation, right? This is either equity or enterprise value, but what you're going to show and discuss with a buyer in negotiations is enterprise value. We'll calculate equity value because we want to continue to run your succession plan and your post-ownership cash flow analysis. But enterprise value is what this is going to get negotiated on, right? We're not going to include any discounts here. When we're selling to a third party, there's no point in putting discounts in. They are probably in their heads thinking about, is there anything in this business that we could reduce the price for? We want to go out and we want to have a good defensible reason for why we think your business is worth 4.5, 4.75, 5 times that adjusted EBITDA. All right. So this is a different type of valuation that underlies a negotiation with a third party. And that third party is responsible for doing their own due diligence, and they're responsible after the close for making sure that the business operates. So your incentive here is to negotiate and try to get the best price you possibly can. All right. What is going on right now? And I know folks are probably interested. What's going on in the M&A market? Is it slowing a little bit? Yes. Interest rates are higher. There's a potential that the economy could slow down. Good businesses are still selling, right? But they're going to have to be very solid businesses. Sustainable EBITDA margins over 10%, not just an EBITDA margin that's gone up because commodity prices have gone up. What are you selling? Do you have value add in the mix besides just selling sticks of lumber? Okay, that can make a difference. And more buyers are requiring sellers to take risk in the deal. This means that the seller is not going to get all their money except for what's put in escrow up front. Right? They are going to have to put some skin in the game, either by financing through seller financing, taking out a note against a portion of the deal, or potentially rolling shares into the new corporation so that now they own part of this new company and they won't get paid out on those shares until that private equity group then would sell that new company or that roll-up company. So important to understand what's going on right now in the M&A market. All right, as we're getting to the close here, what gives your business value? Or we can go down, we can talk about each of these, but your business value comes from you using assets, both capital, financial, and human, to drive money to your bottom line. Right? The better you can do that, the more sustainable you can do that, the more value your business has. And then business value is also associated with the ability of the business to operate without the owner. And that's part of the succession planning process. But if you, the owner, are in charge of purchasing, in charge of hiring and firing, doing all the insurance reviews, et cetera, et cetera, et cetera, that business isn't worth very much to me if you leave. And so part of your job as the owner to get that business ready for sale is to transition responsibilities away from you. That will increase your value to a buyer. Let's touch on this one more time. Net value is what matters. What are you getting in after-tax money? How is the deal structured? We don't have time to go into that today, but it's something we're happy to talk to folks about because there are lots of options to do this. And one that we want to touch on briefly is worker ownership. Right? You've heard of employee stock ownership plans potentially. You may have heard of worker-owned cooperatives. These can be great options for providing a market for your shares. Remember, one of the things that's difficult about a private business is there's not market for our shares, while also providing great tax benefits to the owner and allowing the owner to receive fair market value for their shares. And so this is something to think about. It's not right for everybody, but let's look at some examples here. If you are a C corporation, or you are a C corporation or an LLC that has been taxed as a C corporation for the past 3 years, if you are an S corporation or an LLC that's been taxed as an S corporation for the past 3 years, and you convert to a C corporation, you can sell to your workers. You avoid that double taxation, which would happen if you sold to a third party. And you may be able to roll over the money that you receive into stocks and bonds of U.S. corporations and defer paying taxes, capital gains taxes, on the sale of your company. Even better, if you sell to a ESOP, you may be able to then convert back to an S corporation, and because ESOPs are retirement plans, you are not going to pay taxes on the earnings. Right? If you're an S corporation right now, maybe the goal is you just sell to an ESOP. Now you're not going to pay taxes on those net earnings. You've got more money to pay out the owner at fair market value so the business can function sustainably. So there are some key things here that make this attractive, but it has to be the right fit. Okay, we're about to turn it over and go to Q&A here, Mike, but if folks are interested, please reach out. All right, we can send you these. We're happy to send you these slides. I'll work with Mike to get those out, but book a complimentary consultation with us. Go to the website, download our succession planning kit. These are tools that are there for you. We're always happy to talk to any business owner. Even if we don't end up working together, we can point you in the right direction. We can give you some advice so that you can do what's best for you, your family, and your business. Here's my information. Call, email anytime. We'll get back to you as soon as we can. With that, Mike, I know we've covered a lot here, but let's turn it back to the Q&A.
Absolutely. And Sam, thank you for that great information. We do have quite a few questions here in the queue, starting with, how does the entity type of my business impact the valuation?
Yeah, so good question. And entity type here, we're talking about C corporation, S corporation, or more and more frequently now, there's LLC, right? A limited liability company. And so with a C corporation, there is a corporate tax rate. And then when distributions get made, they're individual, right? The individual owners pay taxes. Whereas with an S corporation or an LLC, the tax rates are based on your individual, what you would pay individually for taxes. And so those taxes matter because if I'm buying your business, I'm going to want to know what my after-tax net cash flow is. And so those tax rates are going to make a difference. Right now for corporations, it's about 21%, right? 21% federal tax rate. And then it depends on what state you're in. Some states have state corporate taxes, some don't. Some have franchise taxes, some don't. Right? So important stuff to think about there. Whereas if I'm looking at buying your business, Mike, and you're an S corporation or LLC, I want to know your individual. What are you paying individual from a tax perspective? What are you paying the state individually? Do you have local taxes? Because these are going to impact that after-tax cash flow, and that ultimately impacts what the valuation of the business is.
Sure. Another question, what deliverables can I expect when I get a valuation of my business?
Yeah, good, very good question. So our process is we go through a discovery. We're going to ask for lots of documents. We're going to ask lots of questions. We always tell folks, don't be put off. Right? We're not interrogating you. We're not trying to make you feel bad about what's going on in your business. What we really want to do is understand your business on a deeper level. And so then what we'll do is we'll do an initial valuation. We'll sit down with the owners. We'll discuss how we came to that value. And with that, we'll produce what we call an initial executive summary of the value of your business. Then after that discussion, there may be some changes that we have to make. Something didn't come out in our initial discovery, or the owner has pointed out something that we didn't notice. You know, maybe they've got a new customer that's going to be sustainable revenue going forward that we haven't considered. Maybe they've switched up, added some products or subtracted some products that are going to change margins. So then we'll make some adjustments and we'll issue our final executive summary. So that in the case of something like an initial valuation or valuation scenario, it'll probably stop there, because then we'll go into more succession planning work. If we're doing it, let's say a gift tax valuation or a valuation for a buy-sell agreement, we're going to issue a more formal report that they can then use either for negotiation in the example of a buy-sell or maybe a merger and acquisition valuation, or that's going to ultimately get attached to a gift tax return. Sure. And so that's an additional level that has to get done for certain valuations that require more formal reports to actually defend the value of the business.
What are other types of typical discounts for lack of control and marketability?
So yeah, so lack of control is typically looked at with a business where an owner owns less than 50%, and they also, from a voting perspective, have less than 50% of the votes. There are setups, and we've done this with businesses before, where somebody will sell a portion of the business to their child, but they will keep the majority of the voting rights. Maybe they'll say, okay, you can own 90% of the business, I'll own 10, but my 10% is got voting rights, your 90% doesn't. And so in that situation, your 10% wouldn't have a lack of control, because they control the decision-making of the company. They're the ones that vote, right? Even though from a distribution standpoint, they own less than 50%, they have all the perquisites of control. And so we have to determine upfront, what does control mean, and does the owner actually have control or not? And so that's going to impact whether or not we put a discount for lack of control on there. And then when we look at marketability, what we do is we don't just look at marketability, there's also liquidity, right? It's harder to create a liquid market for shares of a company that is private as opposed to public. And so we need to start thinking through of how we're going to build that in. There are other things that are tax code wise. Folks may have heard of what's called built-in capital gains. This is something that happens if you were to change from a C to an S corporation and then try to sell to a third party. If you do it within 5 years, you're going to get taxed at C corporation rates. So there's going to be double taxation. So these are things we might need to work into a discount when we ultimately get in there. Our goal is to give you a realistic value of the business based on us coming in and thinking through it like a hypothetical buyer, so that you're not surprised when somebody comes in and they're saying, oh, well, the business is worth $3.5 million. You're going to know, okay, well, here might be the reasons why, and here are some questions I can push back, because this, maybe we came out with 3.75 million, and here's what we're using to get there. And so it's really important to understand these, because they become part of the negotiation of what the ultimate price is.
Sure. How do you take into consideration risks such as commodity price volatility and inflation?
Yeah, great question, right? And one that's on everybody's mind right now. So when we do a valuation, we're looking at 3 different ways. For lack of a better word, we're triangulating in on what our valuation is. We're going to look at what's the adjusted to market value of your assets minus your liabilities on the balance sheet. What are the multiples? So looking at what's called trailing 12 months, which would be, at this point, we would look at November 30th would be the closest month end. So we'd look at December 1st, 2021 through November 30th, 2022. And we'd apply a multiple from actual observed transactions in the market. The third way is what we do is what we call a discounted cash flow. And we're looking at what are potential future cash flows of the business, discounted for appropriate risks to the present. And that's the method where we can really zero in on things like, what might inflation do? What happens with commodity price volatility? All of these things become really important to determining what the business is worth, because we can't just say that a dollar in 2 years is worth what a dollar is today. Right? There's some risk associated with my investment in your business. And what I have to do is try to determine what those risks are and what's an appropriate percentage to discount those to the present time. So to whatever the valuation date is.
Katie asks, how much does a business valuation cost?
Excellent question, Katie. So business valuations are, and they'll split into two categories. One will be if the value is for something like a gift or estate tax return or a grant where we're going to have to not only do a valuation, but also produce a report. And these reports can be 50, 60, 70 pages long to make sure that we're truly defending this value. So for something like that, we're going to charge two different prices, right? One's going to be a price usually between $6,000 and $12,000 for the valuation, and then another, $6,000 to $12,000 for the report, because it's very time consuming. If we're looking at something like an initial conclusion of value, that may be wrapped up in a larger succession plan. We may be doing a 4 to 6 month initial succession plan, and we may be charging a retainer of, 3 to 6, thousand a month for doing something like that. And then that's wrapped up within a lot of other work that we're doing for the client. So my suggestion is reach out to us and we'll speak specifically to exactly what your valuation is and how that might be priced out. But what we really try to do with these is we try to do flat fee. Right? We're not lawyers. We're not charging by the hour. We want you to feel comfortable calling us without thinking that we're running up the bill on you.
The last question I see here from Stephen, if I get a max valuation of business in hopes of selling, does this high value endanger my lower evaluations that has been used for tax purposes, current share value in the past?
Yeah, good. Very good question, Stephen. So remember up top, we talked about the purpose of the valuation. That's where the purpose of the valuation is critical. And in any report that we issue, and in my opinion, that any valuation analyst will issue, there should be a disclaimer in there that says that if this valuation was done for a different purpose, we may have arrived at a different value, because the purpose of the valuation makes a big difference. And if my purpose is to give you an objective gift tax valuation, we're going to take full advantage of what the IRS gives us, which is lack of marketability and potential lack of control discounts. If you then come and say, hey, Sam, I want to sell to my workers, or I want to sell to a third party, whatever is left of the business, we're under no obligation to take those discounts. And so what we want to do there is come up with what we consider a fair value, but it's not going to be the same as what you used for gift and estate tax. And you don't have to worry about that, because of the fact that it's a different purpose for the valuation. And in the report, it should state, if we have a different purpose of value here, we may come to a different valuation conclusion.
Those are all the questions that were in the Q&A section. If anyone has any other questions for Sam, feel free to type them in. Otherwise, I think we can probably go ahead and wrap this webinar up. Sam,
great questions.
Thank you so much for all your great information. And thank you to all the attendants for being here. As I mentioned, we will send out a link of the complete recording of this webinar, and we will have it on our website as well. So thanks, folks, and have a great afternoon.
Take care, everybody. Thanks, Mike.
Thank you, Sam.